Welcome to Objective 1 in Unit 7 of Accounting 3310. In this objective, we're going to examine the income statement and add some details about the income statement that we haven't mentioned so far. The income statement provides performance information about a company. The statement is organized to help readers distinguish operating activities from non-operating activities and persistent activities from one-time events. How do companies organize their income statements? At the end of this objective, students will be able to classify information about company operations on the income statement. The purpose of the income statement includes the following: evaluate past performance of the company, provide accountability for current performance of the company, provide information to assess future performance of the company, and to provide information to assess future cash flows. The income statement, however, is limited. There are some changes in value that are not recorded in income. There are changes like increases in value of fixed assets. Those are not recorded until we have a sale on those fixed assets, or unrealized gains and losses on some securities are deferred onto the statement of comprehensive income. Some amounts depend on the judgment of the company, and so that provides some uncertainty in what income really means. Things like bad debt expense and warranty expense are based on estimates, and so the value of these expenses depends on the accuracy of those estimates. Some amounts depend on general business circumstances rather than really on the performance of the individual company. If there's impairment of inventory or impairment of fixed assets or unrealized changes in value of security investments, it may say a lot more about the state of the economy than it does about the performance of the company. In addition, even companies that have identical transactions can end up reporting different amounts of income depending on their choice of accounting method. Companies can choose any one of 4 inventory methods that can be implemented in many different ways. Likewise with depreciation. There's several standard depreciation methods, but in fact any rational and systematic method is completely acceptable. The income statement is based on revenues and expenses. Let's go over one more time the exact definitions for these. Revenues are inflows or other enhancements of assets of an entity or settlements of its liabilities, or a combination of the two, from delivering or producing goods, rendering services, or other activities that constitute the entity's ongoing, major, or central operations. Expenses have a parallel description. They're outflows or other using up of assets or incurrences of liabilities, or a combination of both, from delivering or producing goods, rendering services, or carrying out other activities that constitute the entity's ongoing major or central operations. Revenues and expenses are disclosed on a gross basis and generally classified on an income statement as operating versus non-operating. Let's contrast those definitions with gains and losses. Gains are increases in equity, which is net assets, from peripheral or incidental transactions of an entity, and from all other transactions and events and circumstances affecting the entity except those that result from revenues or investments by owners. Losses have a parallel description as decreases in equity. Gains and losses are distinctive because they're recognized on a net basis as a single number that's the difference in a transaction. They are typically classified as non-operating items. Income statements can have any of a number of formats, but the 2 major classifications are single-step income statements and multi-step income statements. A single-step income statement lists all of the revenues and gains first, and then all of the expenses and losses. A multi-step income statement lists revenues from providing goods and services to customers first, and then cost of goods sold or cost of services sold, and only then are all of the other operating and non-operating categories listed. In a multi-step income statement organization, there will be subtotals that are useful in evaluating a company. Gross profit or gross margin is equal to sales minus cost of goods sold. This provides us with information shareholders if it has an additional dollar of sales, because when additional sales takes place, there necessarily has to be additional cost of goods sold, so only the incremental gross profit is available for other expenditures of the company. Operating income is gross margin less operating expenses, and income before interest and taxes is operating income minus other revenues, expenses, gains, or losses. Finally, a subtotal of income before taxes is income before interest and taxes, minus interest. Let's make that correction. Operating income is not defined by GAAP, but in general it represents income associated with providing goods and services to customers. That's what's meant by operations. Each company, however, can define operating income slightly differently, so it's important to examine the financial statements of companies that you're comparing to make sure that they're including the same items in operating income. Non-operating income is the income associated with peripheral activities, such as gains and losses on disposal of assets, or interest or taxes. Let's look more deeply at operating expenses. We have used that term several times now. Cost of goods sold is an operating expense. It always includes the direct costs of materials and labor. It can include other types of costs depending on the particular industry it's associated with. Generally, what's included in cost of goods sold is going to be disclosed in the significant accounting policies footnote. Selling expenses are the costs associated with marketing and customer interactions. It includes things such as advertising, sales commissions, and sales facilities, but it also includes bad debt expense. Administrative costs are costs associated with general business rather than a particular product or a particular customer. It includes headquarters expenses and the costs of support services such as accounting and technology. Here's a single-step income statement that lists sales revenue and other revenue, and then lists the expenses of cost of goods sold, selling, general and administrative expenses, other expenses, interest expense, tax expense. When all of the expenses have been listed, they're subtracted out from revenues to get net income. This is organized a little unfortunately because of problems with tabs. The intention here is to have all of the expenses above each other here, and there's no reason to have cost of goods sold sitting immediately after the word sold. Here's a multi-step income statement with much better tabbing. You notice that we have subtotals of gross margin, and then our operating expenses followed by an operating income subtotal, then our other revenues, expenses, gains, and losses with another subtotal of income before interest and taxes, then interest, income before taxes, taxes, and finally net income. This provides a lot of information that may be useful in summarizing the performance of this company. One thing to note is that columns here have a different meaning than they do on the internal accounting documents of a company. Columns on financial statements are not associated with debit and credit classifications. If one column is used, then underline is used to separate segments that are being added up. If multiple columns are used, higher levels of summary are on the right and details are on the left. Income statements generally include all positive numbers. If you have negative numbers occurring, it's usually happening because the numbers in the list include numbers that increase and that decrease income. And in order to distinguish them, whichever is the less common field is generally put in parentheses. This is why you can have somewhat of an unusual situation as illustrated below. Here we have income from operations of $1,000 with 3 adjustments. Unrealized trading losses, which is a decrease to net income, a gain on sale of assets, which increases income, and then interest expense, which decreases income. To show that the gain has the opposite sign of the loss and expense, here the gain is put in parentheses, which indicates it has an opposite sign of the other items in its own column. So you need to read the labels in order to understand what the signs mean on an income statement, because here that 75 in fact is increasing income. Generally accepted accounting principles does not specify what's classified as operating or non-operating, and it does not have definitions for operating income, so there's judgment involved here in companies presenting the performance of their own company to their shareholders. Special items are often non-operating if they're unusual or infrequent, or the result of some factor outside of the control of management, or the result of management policy decisions. For example, restructuring charges are often non-operating expenses, but something as common as refurbishing a factory, even though that doesn't happen every year, it still is likely to be included as an operating item. I'm going to pause here in our description of net income because what continues after this has to do with the items that occur between income from continuing operations and the final net income figure on the income statement. Thank you.